AM Best has just published its market segment report on the 2025 results for insurers in the United Arab Emirates. Joining us from the London office is one of its authors, Saad Abbasi, financial analyst. And Saad, it's impossible to talk about the 2025 results for insurers in the UAE without first considering the effect of the U.S.-Israel conflict with Iran. Can you give us any indication of what might be of concern for domestic insurers?
Sure. The conflict, without a doubt, introduces several concerns for the UAE insurance market. I would say the direct impact has been limited so far due to war-related exclusions. However, the performance can be impacted indirectly because of rising reinsurance premiums. War risk premiums, we have seen the war risk premiums increasing from less than 1% to 3% of the ship value, which is quite significant. Another key concern for the market could be the volatility in the financial market. A lot of UAE insurers are invested heavily in the equity markets, and therefore the financial performance is very closely tied with any movement in the share prices or in the equity market. Another key concern for the market would be inflation. We have seen inflation rising because of the movement in oil prices. This directly affects the cost of spare parts and repair costs, which in turn increases the claim severity for the motor line of business. In terms of capacity, we have seen limited issues so far, but I would say the situation remains fluid, and AM Best expects the insurers to gain more clarity as developments unfold.
The report states that prior to the start of the conflict, insurers in the UAE benefited from favorable market conditions. Can you describe some of those in more detail?
So 2025 has definitely been a good year for the UAE insurance market. The national listed insurers reported a growth of approximately 46% in net profits and around 17% in insurance service revenue. The primary drivers of the growth were strong rate environment, higher business volumes, and expansion of the mandatory insurance schemes. Another key factor that I believe contributed towards the growth in net profits was the absence of any major catastrophic claims. We saw severe rain events in 2024, which led to significant losses in the past, but a CAT benign year led to a favorable claims environment for all the UAE insurers.
The report also highlights a notable trend being the gradual shift away from quota share arrangements toward excess of loss reinsurance structures. What brought this about, and what are the advantages for the UAE's insurers?
As I mentioned earlier, 2024 rain events led to significant losses for the UAE insurers, which pushed up the reinsurance costs across the region. As a result, the UAE insurers redefined their reinsurance strategy to balance cost and capital protection. Pricing increased across multiple lines of business, which was eventually passed on to the policyholders, but the UAE insurers took this opportunity to redefine their reinsurance structures, to reassess their reinsurance structures, and as you rightly pointed out, one notable trend was the shift from quota share arrangement to excess of loss arrangement. I believe this would allow the UAE insurers to retain more underwriting income, but at the same time, they would be protected against high severity losses. It is very important for the UAE insurers to make sure that they maintain the underwriting discipline and the pricing adequacy.
That was Saad Abbasi, financial analyst at AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.